All right, let's go ahead and get started. So today is Wednesday, February 21st. This class is being recorded for publication on YouTube. As we get started today, a few things. I want to do a quick check-in on the Bloomberg Trading Challenge. Just as a reminder, the first half of the Trading Challenge ends on Wednesday, March 13th at 5 p.m. Okay? So that's the final rankings are going to matter by that day. This is section 301. Just going to check in to see how we're doing. Here is where we stand as of today for this section. Again, it's just a check-in. The good news is everybody in this class has done 10 longs. So again, you had to do at least 10 longs by the first half of the semester. We've all met that threshold. Second, we all had to have under $300,000 of cash. That's a continuing requirement going forward, so make sure you don't end up with too much cash. But if the trading challenge were to end today, this is where your section would end up. And we have a clear leader right now, which has made about a 6% return so far. But again, got about three more weeks to go. Questions about the trading challenge? All right. By the way, if you're thinking about the trading challenge, somebody asked me a question, and someone in one of the early classes that I write a quarterly article for a finance journal, and been doing it for a while, so I'm actually running out of ideas to say. So a student asked me a question, it's like, how do you figure out what stock I should buy? And they're more real world than Bloomberg Trading Challenge. And that's actually going to be the premise of, I think, my next article. Because I started to think about this, and I was like, really, you have to address three questions when you want to buy a stock, right? First, you have to understand kind of the baseline. Like, where is the company today? Well, that's why we're doing, to some degree, the next level of historical analysis to establish the baseline. You need to understand the business model, how much they're making, who they're selling to, what's the market like, et cetera. Got to know the current situation. Number two, second question is, what's the future look like? Think about a company like NVIDIA, and we talked about their potentially bright future with AI chips. So we got to kind of know what is that expectation for the future? What are they expected to do? Okay, and so that's why we're going to be dealing a lot with the future in this class. Future expectations are really important. That's the third cornerstone of value creation. And then the final question, so the market figured it out. Meaning, does the market understand the future realistically of the company? Because if it doesn't, the company's going to be mispriced, right? Because if the market doesn't understand that the future is as good as it is, the company's price is going to go up. That's what happened to Facebook, by the way. When Meta started to turn things around a few weeks ago, basically the market didn't understand how good Mark Zuckerberg said it was going to be for Meta and Facebook, and they underpriced it. And it was a buying opportunity. And sometimes we get, the other has been happening more with Elon Musk, which is there's been a slowdown, which we've talked about in this class, about the transition to electronic vehicles. In fact, the latest news is the Biden administration is now talking about slowing down the requirements for emissions on automobile companies because they don't think that they're going to get to enough electronic vehicles in the time frame that they're pushing them to do it. And they're just recognizing another sign that electronic vehicles are not selling as fast as a lot of people would have hoped. And so that market reality is starting to set in, and companies like Tesla have had to adjust to that. Okay? And so basically Tesla might have been a little overpriced for that. But that's the idea, is that we got to answer that third question as well. And so back to the trading challenge. I'm going to tell you a trading opportunity today. I don't know the answer to this question. I do have a personal stake in this because, transparently, I own this company's stock. It's called NVIDIA. Okay? NVIDIA reports its earnings at 4 o'clock today. Okay? And according to the options, it's going to go up or down 10% tomorrow. Like, it has a big move attached to it today based on what it does at the end of the day. Because the whole point is, you saw the future. Matter of fact, you can see it in Bloomberg. This is the future that Wall Street expects EEO right now for NVIDIA. And just look at revenue as an example, that for January 2024, which is their fiscal year, which they're about to report today, Mark is expecting $59 billion in revenue, top line, for last year. And that's the whole point. It's a check-in. Did you get to the $59 billion in revenue? Is going to be a real key point when they report their earnings today. And the profit targets associated with that, because it's also expecting EBITDA jump to $35 billion according to the analysts. Did they get to $35 billion in profit last year? So that's going to be a key check-in point. And then they're going to look for guidance. on the future because in the recent run-up of the stock price, NVIDIA is now worth like 1.7, 1.8 trillion, and probably a little less based on the share price today, down $24. But so that can give you a hint on what the market's expecting in terms of their earnings call today. So that then the question is, what are they going to say about their future, right? And that's going to be a big question mark, which the earnings call is going to try and address. Because the first thing that's going to happen at the end of the day, and you can already see people betting on this, is they're going to come over here to the quarterly view. And in Bloomberg, this is the expectation right here for the last quarter. And when they report their earnings, they're going to have these two side by side. They're going to have what was expected, and they're going to have the actual for the quarter. And they're going to compare. And are they on track? And I'm just telling you, if they're behind schedule, then all those numbers into the future start to look harder to get to. And if they're ahead of schedule, then all those numbers in the future look like they could actually achieve them. Maybe they're unrealistic. But I'm saying that's where you have opportunity in the trading challenge. And I'm just telling you, you're gambling here. But there's going to be some volatility, and there already is. You can see in the stock price today. So again, that's where you can make or break your Bloomberg trading challenge, just FYI. So I don't know how it's going to go. I don't have any inside information, but I know it's going to be a ride. So questions about any of that? And you can find other companies in the situation, but that's the point. It's that third question. The Bloomberg trading challenge is about the third question, which is, does the market have the expectations right? And when new information comes out, is the expectation going to change? And there's tea leaves. Matter of fact, one of the reasons against this, I'm personally optimistic. Somebody in the last class actually asked me, like, what do you think is going to happen? I'm 70-30 that I think they're going to beat expectations, right? But here's the reason why I worry, and this is what the market worries about, is the trade war between the U.S. and China. Because the Biden administration has limited NVIDIA's ability to sell its highest-end chips to China. And that's just a big market. And if you can't sell chips to China, it's hard to meet some of these sales forecasts that they're talking about, okay? And so I'm not saying they're not going to do it, but it just makes it harder. So it's not that they're going to get big, it's a question of how big and how fast. That's why there's just uncertainty in this. And by the way, when there's uncertainty, that's when stocks move, okay, in either direction. You have a point or question? Okay. Anyways, not saying you have to buy NVIDIA, but it'll be an interesting ride. We'll see on Talk on Monday how it ended up doing. But we're still at the end of earnings seasons, and between now and I think companies have until March 31st to kind of report almost all their earnings for the S&P 500. That's where there's still some opportunities in these stocks. Yeah.
There's a lot of news about NVIDIA being the most important stock to watch right now in terms of earnings.
Well, because, back to the S&P 500, they are worth, at this price, almost 1.7 trillion. They were 1.8 trillion a couple days ago. But the problem is, in the S&P 500 index, it's a stock-weighted index. So when NVIDIA moves now as the third most valuable stock in the United States, and therefore in the S&P 500, it actually has a big weighting on what happens to the S&P 500. So it's part of the reason why it's been driven up. And if it starts heading down, could go down. But that's the whole point. Hey, if NVIDIA is missing, maybe Amazon's going to miss. Because Amazon Web Services isn't going to get as much cloud business as we thought. Like, it could play into how they look at some other stocks. So absolutely, this is a very important bellwether call. Sorry, question? Yes?
I think AI optimism would decrease if earnings miss.
Then you know what you should do with NVIDIA. Okay? So I'm just saying, there's either direction. I can't tell you what's going to happen, but that's, if you can make the judgment call, there's an opportunity. Okay? And if you're not willing to make a plus or minus 10% bet, probably want to stay out of NVIDIA today. But as you think about the trading challenge, these are some opportunities if you can figure out to be on the right side of the answer to this question, and reading enough tea leaves to figure out what likely is going to happen, not just in the past, but how this plays out in the future. Okay? And if you really want to get depressed, I'll tell you about another call at a different day, but I've made two bad calls in my life in terms of predicting when the market was going to get really fugly. And one was in, you go back and watch the video, we were in January 2020 in this class. COVID was starting to spread, and people didn't realize how bad it was. And I was like, watch out for the market. Like, it's going to get so bad so fast, people don't realize it. And we're not prepared for what's about to happen next. And I wish I was wrong. But unfortunately, I was right about what's going to happen to the markets. And a lot of people died. I worry about what's going to happen in November 2024 in this country. And we don't remember the political violence that occurred in 2019 and 2020. I'm not just talking about the march and riots at the Capitol. I'm talking about a couple months before that, when there were riots in Washington, D.C., that the government had troops put down against American citizens. I feel we're heading right back for that again in this election. It doesn't matter who wins. It's just, we're in a desperate strait as a country, and we're moving towards that. And I fear, not just for our country, I fear what it means to the markets. Meaning we are not prepared for that level of disruption in this country. And I'm not saying it's civil war, but it's just not healthy, right? And I hope I'm wrong, I really do. But I fear where the markets are gonna go at the end of the year if we actually start having the problems that we're likely to have in our political process, right? Yes, sir.
Do you think that, given the result of the election, if, I'm not saying it'll happen, if Trump does get elected, do you think the market will jump in the same manner that it did when it was elected in the 16th?
It depends. And the reason why is there was an article today that reminded me of all this, that scared me about all this, which was, it was in the New York Times, and basically it was one of the columnists who I respect, and what he showed was the Consumer Confidence Index that is published, but they showed it by party going back to 2017 when they started tracking it by party. And what was ironic is between 2017 and 2020, the Democrats thought consumer confidence was terrible and the economy was going to go in the tank, and Republicans thought it was going to be the greatest thing since sliced bread. And since 2020, 2021, it's flipped. Now, Republicans think the economy is going to hell in a handbasket, and the Democrats think it's going to go well. And we're looking at the same data. That's the part that's kind of frustrating about this. Like, we don't have an objective reality anymore in this country, regardless of political party, and that bothers me. All right? And literally, I try to watch Universe 1 on CNN and NBC, and Universe 2 on Fox News. And I try to keep both universes, and they're getting further and further apart. Right? And we're looking at the same information, and that's the scary part. And it's not whether I agree one side is right or wrong. It's just how can there be so much difference over the same data? And that's what I worry is going to happen in the marketplace, regardless of who wins, because that's not healthy. We can't look at the same facts and come to completely different judgments. And basically, because that just creates too much uncertainty in the environment. So the flip side is there's a benefit that the Republicans feel that will happen to the economy with Trump, but there's the uncertainty that will come with it, and that uncertainty is what's going to create volatility in the marketplace. And I'm just telling you, like, if we have mass protests in the streets of the United States, if we go back to like 1968 again, like, that's not going to be healthy for this country. And I worry that we're heading there. And I know that's not a business class, but it does have business consequences. The market's not there yet. This is what you're going to be talking about in September, October, leading up to the election and after the election. But it's something to pay attention to, because it's no different than NVIDIA, which is trying to figure out, will this be a big deal? I hope I'm wrong, right? But like when I saw COVID coming, I worry. And that's the one thing on the market that does have me really worried about. Forget about political party, just consequences to business. It's going to have a huge consequence to business if we have lots of disruption on either side. And that's what I worry about. It doesn't matter who wins. The other side is now, in their universe, going to be upset that the other side won. And we just haven't had that in this country historically since the 1960s. And it's back with a vengeance. And that could be very, very disruptive. Yes?
Did you get all your data about COVID from Bloomberg, like as it was?
Bloomberg at the time hadn't put their dashboard together, but I was actually looking not at just Bloomberg, I was looking at what the scientists were saying. And what the scientists were saying scared the hell out of me. It turned me white, because it was basically, there's this virus, and there's not a lot of information about it, for whatever reason, didn't matter, and we don't know how bad it's going to be, but the early data suggested it was going to be worse than the flu of 1918. And it took a while for us to absorb it in this country and around the world, but as you saw, it had devastating consequences at the time, because we were just unprepared for it. And that's the whole point. There was just so much uncertainty. That's what I worry is starting to happen again. We're heading into a world of so much uncertainty, and I don't think we as a world are prepared for the uncertainty that is being created in either direction. And by the way, uncertainty equals volatility. Volatility means higher risk kills stock prices. And that's the trade over consequence that I start to worry about, is we could end up with a world where the stock market gets really crushed because of all the uncertainty that's happening. And I'm not even talking about the political uncertainty, what's going on outside the US with all these wars. I mean, that's not healthy as well for the rest of the world. So we're just in a world that has gotten a lot bad a lot faster than a lot of us have expected. We were kind of used to things kind of going around, and now we're hitting rapids. And those could have consequences on the market. But that's a whole different story, whole different class. Yes?
You said you predicted that the market would like drop. Do you also think that it was going to rebound as quickly as it did? Because I feel like that was pretty historic rebound.
I predicted it was going to drop. I think I told when we got down to the 40% drop, I said it's probably a buying opportunity because I do think we were oversold, and I was bullish that we were going to get past COVID and the world was never going to end. And the same thing will be true as we come to the election. Like I think there's going to be volatility and eventually it'll settle down. But I can't tell you that in November, early November 2024, my entire portfolio might be in cash on a personal level. It's entirely possible I may be there if we continue to head down these trends. But that's a different story. So back to this. You had a homework assignment due today that I know many of you struggled with. And I'll just close out the last point, which is this gets back to the Bloomberg Trading Challenge. Like, forget about the politics, think about the short term. That's what companies have to deal with. We have to understand what the expectation is and what the market thinks about that expectation. Do they really understand it? Do they believe it? And could it change? Because when there's a disconnect, that's opportunity. Okay? And you will make money on opportunity in the Bloomberg Trading Challenge. Because that's not how you think about it, how stocks are going to do over 5 years. All right, over 5 years, you can think about, okay, you're going to consistently outperform, you will outperform the market. That's kind of the long-term cash value. But in the short term, stock price has nothing to do with actual performance. It's all performance against expectations. And that's why it's so hard to beat the market, okay? Because that's what's happening with NVIDIA today. Unless you're an insider, you don't know whether or not they're going to meet this expectation. And that's what they're going to be judged on, performance against expectation today. And that's why, because there could be a big delta with this stock, that's why it's likely to move. Okay? All right, so you had a homework assignment, which for many of you is probably going to be the most difficult assignment you're going to have to do this semester. And I made a change in the last class. So under Files, under Homework 4, there's now a folder. And in this folder, I'm going to update it. This is the solution to Homework 4. Okay, the economic statement conversion. So I want to start by going through that. All right, 4 tabs. You started out with more complicated income statements and balance sheets. To be honest with you, it shouldn't matter. Doesn't matter how many years I gave you. Could have given you 5, could have given you 7, I gave you 3. You're just kind of copy and pasting the rows. Okay, so that should, or columns, that shouldn't be that hard. All right, and then the rows, more difficult just because there were new categories, but I gave you labels. So if you kind of followed the label process, hopefully you were able to complete the assignment, but nonetheless, that's what we're about to go through the solution. All right, so I'm going to start out with the rearranged balance sheet, which was the TFI. And basically talk about the solution here. So the first thing when you rearrange the balance sheet is you want to follow Modigliani-Miller. So we want operating, the non-operating, debt, equity. So these are all the operating items, right? In our parlance, these are all your ones. All your asset ones, all your liability ones, you put them on here and you net them. And the netting of the asset and liability ones gets you your operating invested capital, right? So row 14 is what we're looking for in the solution. Now in this solution, I went an extra step that you didn't have to do for this assignment, and I further bucketed the assets into operating working capital and long-term capital, okay? And you might say, gee, why did he go this extra step that he didn't show us on Monday? And the answer is because in the next part of this class, when we do forecast valuations, we're going to start getting a little more granular about operating invested capital when we forecast. So I'm setting that up in the solution. You didn't have to do this, but here's what I mean. When this company grows, the rate at which it grows its working capital, think inventory, is probably going to be the rate different than the rate it would spend on building plants, property, plant, equipment, right? So I'm going to want to forecast those to grow at different rates. Well, if I just do one operating invested capital, I can't really do that because it's all just blended. Matter of fact, the same reason why we're doing operating and non-operating capital as opposed to average capital. Because the problem is when you have an average capital for a company, you can't forecast the operating and non-operating to grow at different rates. Now we can, and I'm just going to click down and give us one more part of granularity to further break down current and long-term capital growing at different rates. So that's why it's separated. But you didn't have to do that for this assignment. I just structured it in the solution because going forward, this is the format you're going to see for the real-world companies that we look at. It'll look more like this. Okay? But nonetheless, that's the other thing. This is why this class is different than accounting, because accountants treat working capital as all current assets minus all current liabilities. We don't do it that way. We do, for operating current assets, for example, we break up cash into operating cash and excess cash. Accountants don't distinguish that. It's all current assets to the accountants. We take current portion of long-term debt or short-term debt, and we call that a 3. We pull that out of current liabilities. Accountants don't do that. They leave it as part of current liabilities. So you can't just go to Investopedia, use the traditional definition of working capital, and it just won't work in this class. All right? So that's the adjustments that you made here, which is operating cash is a 1, excess cash is a 2. All right? And I gave an example of what I meant by excess cash on Monday. And I said, look, when I was running a company, we had $80 million of cash, and 20 million of it, I knew that we could never pay out. Like, that's operating cash. And I knew that the other 60 million was discretionary. That's excess cash. All right? And so that's the point. The 20 million would go as a 1. The 60 million would go as a 2. A traditional company would just list 80 million of cash. Okay? And so these are some of the nuances and these adjustments that we are making. Is that kind of clear to everybody? But nonetheless, you needed to get to 3.26 billion, 3260 of in 2020 invested capital. Okay? That's the operating invested capital. All right, all the assets netting of the liabilities. Then we go to the non-operating capital. Okay, 2 assets, excess cash, equity investments. And then we had a non-operating long-term liability, which we net out. So add up the 2 assets, subtract out the liability, we get 465 million in 2020 of non-operating capital, just focusing on 2020 for the solution. And if we add the invested capital, the non-operating capital together, we get TFI. That's the total investment, 3725. Did you get to these numbers? Does anybody have questions about these numbers? Of the 4 statements, this is probably the easiest and more straightforward one. Okay. From that, we would add in the debt and the equity. And the debt and equity, again, the investment has to equal the financing. So the debt and equity had to add up to 3725. So we take all of our 3s, all of our interest-bearing debt, the short-term and the long-term in this case, and then we take all of our 4s, which was listed as the equity accounts, minority interest, preferred stock, common stock, retained earnings, and treasury stock, sum them up, and that should equal your investment. Okay? So again, we have total investment in the firm equals total interest-bearing financing in the firm. These are the people that require return, the 3s and the 4s. And the total investment is how much was in operating and how much was non-operating. That's the rearranged statement of TFI we now have. Questions about TFI? TII. Similar process, we're just now going to do this with the income statement. Right? So here's what we're going to do with the income statement. We are going to take all of the operating items, all the 1s, and that's going to give us the operating part of the income statement. In this case, that's going to be called NOPAT or NOPLAT. Okay? And so that's just our EBIT after tax. So EBIT times 1 minus the tax rate. Hopefully everybody got NOPAT right. Right? Those are the numbers, 217, 161, and 133. Right? Then we take our non-operating items on the income statement. One is interest income, and the other was labeled as non-operating gains or losses. Again, tax affect those. That gives us our after-tax non-operating income. Now, you could have done this one of 2 ways. You could have netted the interest income and operating income or loss and then tax affected it. In this case, I broke out the 2 individually and then added them up. But either way, you had to have both, and you had to basically tax affect those. So we ended up with 30.8 million in column B of non-operating income, which was the 16.8 plus the 14. Okay. And then interest income, in case you're curious, here's another distinction between this class and the accountants. All right. Some people, as I referred to this on Monday, will talk about a concept known as net debt. Okay, debt minus cash. All right. And I told you one thing we couldn't do with net debt is you can't take all the cash and pay it out. That's why we do operating and excess cash. But I'll add another thing here. What they'll do with the net debt is they'll also talk about net interest. And they'll take their interest income and interest expense and they'll net it out. And they'll call that net interest expense, right? We don't do that because here's the point. We're mixing apples and oranges. Interest expense comes from debt, which is a 3. Interest income is on your excess cash, which is a 2. So we don't do net interest expense because we're mixing operating and debt by doing so. We're breaking it out. That's why interest income is in this section and interest expense is in the next section. Okay? Because one's a non-operating asset and the income on the non-operating asset, and one is debt and the payments on the debt to those people. So we're putting it into the right bucket. Right? So that's our non-operating income, NOPAT plus non-operating income, TII. That is the total income to investors. And again, we'd hope that this is positive. That means we're making more money than we spent, the whole point of a P&L. And if it's negative, that means we're losing money. But the whole point is the next section, the financing flows, will equal this. Because if we made the money, where did it go? And it must be equal. And if we lost the money, how do we make it up? It's got to be equal. So if I get to 247.8 in column B of TII, then the bottom half of the TII has to equal 247.8 because it's what I did with that income. Did everybody get to these numbers? Row 15. Questions about row 15? Then we get to how do we spend the money? Interest expense, tax shield on the interest expense. We did this on Monday. After-tax interest expense, the 37.8 in the first year. We have the minority interest payments to the shareholders, and then we have the net income. So you add those 3 up, and you get the 247.8. Payouts, positive numbers. We have income, therefore we can pay out money. Positive income, positive payouts. That's why they're positive on this statement. This is not GAAP accounting. Questions about the TII? Is everybody familiar with the concept of minority interest and what it means? All right, I see you nodding your head. What is minority interest?
It's the percentage of a company. If you own another company, at least 50% of that company, but not 100%, it's referring to the percentage that you don't own because you would have combined income statements and you'd be comparing apples to oranges if you assumed you owned all of it.
Okay. So, great answer. So just so everybody catches up on this, right? So here's where minority interest could come in. And I'll try and draw it here on this virtual whiteboard with my mouse. So just, I apologize. I know it's going to look really, really bad. I do a poor job drawing with my mouse. All right. So here's the idea. We have 2 companies. And I'll go to drawing. So I'll follow up in the example that he just gave. So these are supposed to be the assets. These are the liabilities, and this is the equity. And we have another company who has assets, liabilities, and equity. Okay? So here's the deal. In accounting, if you own or control a company, more than 50%, okay? But you don't own 100% in your business because somebody else owns a minority stake, okay? Then you have to treat the business as if you own 100% of it, which means you have all the assets, okay? You don't take a portion of the assets, you literally say, I own all the assets, even if I don't, okay? But there's a portion of those assets that you don't own that belong to somebody else. That somebody else's investment is called a minority interest, okay? So let's say that we, the company on the left, own a joint venture with the company on the right, and we own 70% of it, and they own 30% of it, okay? 100% of the assets goes into our assets, okay? But on our equity account, right, it's kind of a liability, it's a quasi-equity account. There's an item called minority interest, which represents the stake that we owe to the other company for the partial assets that they own, not 100% of the assets. And it's listed separately than the common equity because they're not entitled to the performance of all of our assets. They're only entitled to the performance of the assets that have been consolidated. Does everybody kind of follow that? So on our balance sheet, we are going to have at the top of the equity list, as I said, it's almost like a liability, something called minority, I'm trying to do an M here. It's supposed to be an M, interest, which for this other company down here is a longer term asset. They are going to call this an equity investment. So for them, it's going to be an asset. For us, it's going to be a minority interest. They'll be corresponding. Okay? So if they gave us $10 billion, all right, then we'll have $10 billion of minority interest, and they'll have $10 billion of equity investment. Okay? Does everybody see that? Questions about that? Okay. Point number 2. And this has to do with cash flow. Because we control the company on the left, all of the company's assets, we take all of the company's revenue and all of the company's profits as if they're our own. So we have a total P&L, which includes both, right? And the government is going to make us, the controlling shareholder, pay the taxes because they don't want to be chasing down every minority shareholder for their taxes. So we, the controlling company, owe the taxes on the total profits. So we take the profits and we pay the taxes. After we have paid the taxes, not all of the money left belongs to our common shareholders. Some of that belongs to this other company on the right, belongs to their shareholders. So we have to send them a portion of the profits. That is the minority interest dividend on the income statement. So in the balance sheet, we're going to have an equity account, which is a quasi-liability, of the money we owe to the shareholders that we have consolidated. And when we pay those minority shareholders on the income statement, we're going to have an after-tax distribution, the minority interest payment, to those minority shareholders because they don't get a share of our total profits. They only get a share of the profits in the business that they own. Everybody follow that? At least basically? Yes, sir.
On the income statement, it was listed, the minority interest. The minority interest was listed as a negative value. Does that mean money was coming in from the minority stakeholders?
So hold on. Let's go back to our example here. On the balance sheet, I'll start with TFI, rearrange balance sheet. The minority interest is $300 million. That's a positive number. They've invested $300 million as book value, doesn't change. Okay? On the income statement, TII, they were given payments of $20 million, $25 million, and $22 million each year respectively. Those are positive numbers. So those are the positive dividends, $20 million, that they got on their $300 million investment. And they were given $20 million because $20 million was their share, not a share of the 247.8. They weren't entitled to all of the profits. They were only entitled to 20 million of the profits. The other 227 million went to the common shareholders. That's proxy and the other expenses, net income. Yes?
On the financials tab, the minority interest is reported as a negative value on the income statement.
Yes.
So that's what I was asking.
Doesn't matter. And I sort of highlighted this. I made a couple of comments in the class on Monday, but I said, you're going to be given numbers by the accountants. And just because they give us depreciation as a negative number, we know that that's an addition to cash flow. Well, that's the whole point. Like, you're going to get statements from people, and sometimes they're going to give you, sometimes they'll say revenue minus cost of goods sold, and cost of goods sold is a positive number. And other companies might say revenue minus cost of goods sold, and cost of goods sold is a negative number. But either way, you know that you deduct cost of goods sold from revenue. That's just accounting, and I can't help you with that one. There's not an always in the real world. It's one of the reasons why I hate accountants, which I'm saying on YouTube. I respect accountants, but I don't like them, right? Because you make our lives difficult. Like you do stuff in paper that has no impact on cash. Like, why do you waste our time? We generate a lot of billable hours for that, but why do you waste our time with that? Just focus on the cash, right? So, anyways, this is one of the reasons why I don't like accounting, because sometimes they'll give us a one way or the other way. We've got to figure out what's right. Sorry, it's just real world. So, yes, I showed it to you as a deduction, but you need to recognize a deduction on this side of the statement represents a cash out, and cash out's a positive number. That's what you got to understand. That's why I said you got to use your thinking caps. This is not a, solve and forget type of an exercise, unfortunately. No good answer for that one. All right, questions about TII, TFI? Everybody get these numbers? Great. I'm guessing most of you struggle with this one, the CFI, cash flow. Okay. So again, a couple things. High level, what we're trying to do in this statement for CFI is we're trying to get to CFI, cash flow available to investors. The whole idea of cash flow available to investors, CFI, is we're trying to say how much cash is coming in from operations, primarily, and how much cash is going out. And so basically that's the whole point of free cash flow. If we generate more cash coming in than cash going out, we have the ability to create value. If we have more cash going out than coming in, we're never going to create value. So that's the whole point of free cash flow. Are we generating more cash than we spend from operations? Are we generating more cash than we spend from non-operating activities? When you add up our total business, are we generating more cash than we spend? That's a CFI. So anything that helps cash come in, we're adding, and anything that's cash going out, we're subtracting, and it's just a net. We're just netting it, okay? It's just the concept. Now, very specifically, what we're doing, because of accounting, and I told you my love for the accountants, is a balance sheet is explained. Starting and ending balance sheets are explained by the income statement in between. The income statement is basically the difference between two balance sheets. That's what it is. Okay? You got 2 points in time, and what happened over that period in between, that's your P&L. So the income statement is the change, the balance sheet is the end. So if I'm trying to figure out how much cash is going out, income, positive or negative, generating cash, losing cash, that's pretty straightforward. Balance sheet, did my investment go up, did it go down? Because if it went up between the two periods, I spent cash. If my investment went down in my balance sheet between the two periods, I freed up cash. That's the gross investment. Okay, so we need to understand that. So gross cash flow is the income statement. How much cash are we generating from the income statement? It's our NOPAT plus depreciation. That's called gross cash flow. All right. Now, the reason why we have to add the depreciation just goes back to, again, my love of accounting. Because if you're a for-profit company, you have to, number one, take your long-term assets, like a building, and spread out the cost over 20 years, called depreciation. And that's a non-cash expense after you spent the money. So every year, you're going to have non-cash expense. So when you get to your EBITDA, you can subtract out your non-cash depreciation expense. And the reason you do that is because you can then deduct that from your taxes. So even though depreciation doesn't directly affect cash flow, it indirectly affects cash flow because you can tax deduct it. You can write off that as an expense and then pay less taxes because of that. So that's why you solve for your NOPAT, but because it was a non-cash item, you add back to get to your gross cash flow. If there were no taxes, who cares about depreciation? It wouldn't matter, right? So the only reason from a cash flow standpoint we care about depreciation is that basically because it does indirectly affect the taxes, right? Now, some people in the real world will use EBITDA as a proxy for NOPAT, right? Now, if you're a not-for-profit, okay, makes sense. If you're a for-profit, understand that there could be a difference. Because if you use your EBITDA, you're not looking at the tax impact of the depreciation, which will affect your cash flow. And so EBITDA and NOPAT are close to each other, particularly in a low tax environment, but they could be different because of the tax impact of the depreciation. That's why we're doing this mechanics of solving for NOPAT and adding back the depreciation, because we want to get to the actual cash flow, right? But nonetheless, that's gross cash flow. Hopefully everybody got that one. That was the formulas. Then it's the gross investment. I gave you the shortcut on Monday for gross investment. And it's based on this. If basically we start with a balance sheet, we end with a balance sheet, the difference between the two balance sheets is how much you spent. That's your gross investment. So that was the formula. Ending operating capital minus beginning operating capital plus depreciation equals gross investment. Gross cash flow minus gross investment is free cash flow. So here's the point. In the solution, I got more granular, okay? Because I wanted you to click down. So if looking more granular is the change in the working capital, and that's the whole point. If working capital goes up, I'm spending cash. That increases my investment. If working capital goes down, I'm freeing up cash. That decreases my investment. In this case, working capital, you can see based on the TFI, working capital went from 810 to 767. So if they're decreasing their investment in working capital, that's freeing up cash, which means disinvestment. Then we have our capital expenditures, how much we're spending on property, plant, equipment. Then we have our change in goodwill. Then we had our change in other long-term liabilities. All of those are changes with the one exception of CapEx. Okay? Change in net PP&E is not capital expenditures. Right? The formula for CapEx, which most people will get off of the statement of cash flow, they'll just get the CapEx. I'm making you solve for it. Right? Because if the income statement explains the changes between two balance sheets, this formula has to work, which means if I start with my beginning net property, plant, equipment, I add in my capital expenditures for the year, and I subtract the depreciation, I get to my ending PP&E balance on the next balance sheet. If I don't follow that process, my balance sheets won't balance. So this has to work. But by the way, knowing this has to work, to explain the two balance sheets in PP&E, I could rearrange the formula. CapEx equals ending PP&E minus beginning PP&E plus depreciation. Okay? That's how you actually get CapEx. You could solve for it that way, or the company could give it to you on the statement of cash flow. Right? In this class, I'm going to make you solve for it for a reason I'm about to tell you, but the whole point is, when you look at all of the investments, you add up the end minus the beginning, and then you have this plus depreciation. The plus depreciation comes from the CapEx. That's why there's a plus depreciation in here. All right, if we didn't have depreciation, we just do the beginning and the end. That was the investment. It was the change in the operating capital plus the depreciation. That was the shortcut, which you could have done it more granularly. You could have done the shortcut. I showed you the granularity, but that's the gross investment. Free cash flow. What is free cash flow? Gross cash flow minus gross investment is free cash flow. If I have a positive free cash flow, I'm generating more cash than I spent. If I have a negative cash flow, then I spent more than I'm generating. And over time, you got to have positive free cash flow. Can't run a business with negative cash flows. Not for the long term. Questions? All right. Here's the reason I'm making you solve for CapEx, and another reason why I don't like accounting. Okay? Which is, I was telling the other classes, I watched a TV show called Yellowstone, and there's a joke, running joke on Yellowstone of a place they call going to the train station. Does anybody watch that show, and does anybody know what the train station metaphor means? The train station on Yellowstone, the TV show? Do you guys watch Yellowstone? Anybody watch Yellowstone? Maybe your generation doesn't watch it. I'm an old geezer. Nobody knows? So, and that TV show, the train station, is basically where they throw the dead bodies never to be found again. So in the hypothetical world of Yellowstone, they own a ranch on the Montana-Wyoming border. So they go right across Montana to the border in Wyoming where nobody lives and there's no cops. And they basically throw the dead bodies there, and they're just lying on the side of the road down the bottom of the cliff where nobody ever looks. So for 100 years, that's where all the dead bodies go. Okay? So when you don't want anybody to be found that you need to kill off, you take them to the train station. Okay? And so the equivalent of the train station that the accountants use to bury all the dead bodies for real world companies, and you're going to get a lot of money for this, by the way, if you go work for like Ernst & Young, is AOCI. AOCI is a scourge. And I hate AOCI. And I hate the fact that accountants are using AOCI adjustments for companies. Does anybody know what I speak of? What is the corporate train station of AOCI that I speak of? Does anybody know what AOCI is? You guys are accounting majors. Adjusted Other Comprehensive Income. There's a fourth statement. Income statement, balance sheet, cash flow, and fourth statement called? I'm sorry? No, it's not called AOCI, it's a statement. The statement is called? It's like statement of changes in equity. Okay? It's a statement that nobody knows about, nobody looks at. because you're trained to look at the income statement and balance sheet and cash flow statement, because those explain what's going on. But there's this fourth statement that nobody ever pays attention to, called the Statement of Changes in Equity, which is supposed to explain the changes in equity between the two periods. And one of the items on the Statement of Changes in Equity is called AOCI, which back in the 80s, when I was at Wharton, nobody used this account. Last 50 years, everybody uses this account. And the reason they use this account is because nobody pays attention to it, right? And here's the point. I told you that the income statement is supposed to make sure you explain all the changes between the two balance sheets go through the income statement. But, here's the big but, accountants have found a way to directly change the balance sheet without having items flow through the income statement. And one of the adjustments they make is something called AOCI. It's a pure equity adjustment. So it just affects equity. It doesn't affect cash flow, right? But nonetheless, it doesn't hit the P&L. And that is a problem that I have. Because not only myself personally, but most people don't go looking through the footnotes, looking through the accounting adjustments, and that's where the bodies are buried. Because people know that nobody's looking down there, so that's where they'll make their write-offs and adjustments, okay? And that's one of the problems with CapEx, is that the CapEx that a company reports on their statement of cash flow doesn't always equal the change in this formula that it has to equal to. And when it doesn't, it's because there's been an AOCI adjustment. Okay? They've taken something out of their PP&E and they've made a direct adjustment on equity on the balance sheet, and they've basically reconciled it with the cash expenditures, and they got the balance sheet to balance that way. But if you didn't go looking through the fourth statement and you tried to go through our process and you use the reported CapEx from the cash flow, you wouldn't get your statement to balance, and you have to figure out what equity adjustments were made, and you're undergrads, and this is complicated enough, and I'm not gonna make you do that. That's why we're gonna solve for CapEx, because that's the only way I know that the balance sheets will have to balance. But what I'm telling you is the reason you're doing that is because we are not trying to find these direct equity adjustments. And the reason why I don't like them is because they don't really matter. They don't have any effect on cash. And as a finance person, I care about the cash flows. As a CFO, I cared about the cash flows. Like, I had accountants doing these adjustments all the time for reserves. And I'm like, what's the point? I'm giving you lots of billable hours. How much is this gonna affect our cash? And they're like, it's not. I was like, well, why are you doing this? Right? Because accounting rules make us do this. So we had to pay lots of money for things that were trivial that really didn't matter. Okay? What matters is the cash. Okay? So that's the thing. We are focusing on the cash flow. But I will tell you, many of you will make your careers doing these equity adjustments with lots of billable hours, and you'll make partner and get rich doing it. So have at it. But I'll still dislike you. All right. CFI. That's why we're using the formula here. Okay? Make sure your balance sheet's balanced. All right. Next, non-operating cash flows. Take your after-tax interest income, non-operating income, change in the balance sheet, change in excess cash, change in equity investments, other long-term liabilities. Okay? So basically, add the income statement items, look at the change in the non-operating items, and that gets you your non-operating cash flow. Okay? So negative 440.6. Now, the one that you probably were most concerned about was how to figure out the sign for change in excess cash. Okay? And I'm going to give you a metaphor that will hopefully give you a better understanding of the way the sign for excess cash should work. So this is real life. So in the real world, I have a checking account at Chase where I pay all my bills. Okay? Got a mortgage, got a car payment, my salary goes in that account, pay all my bills. Utilities, whatever. Okay? Live off my checking account. I also have essentially a retirement savings account at Fidelity. Okay? So that has a 401k and some other retirement savings funds. Okay? That's where I transparently own NVIDIA stock. Okay? That's in my Fidelity account. So here's the point. I don't actually make my car payment, the BMW, from Fidelity. Doesn't make any sense. I don't raid my 401k to make my car payment. My car payment comes out of my Chase account. Okay? And so that's the point. That is operating cash. My Chase account is operating cash. It's the account of which I pay my bills. My Fidelity account is my excess cash. That's my savings account. And I don't use my savings account to pay my bills. Now, let's say that I am on dire straits and I don't have any money. All right? I still owe my car. I might raid my 401k to make my car payment. Because I don't have any other way to pay it. So here's the point. I'm gonna pay a big penalty, so I don't wanna do that. But what I'm likely to do is I'm not gonna send from Fidelity, my 401k, a direct payment to BMW. I'm gonna take the money as a distribution penalty from my 401k, I'm gonna put it in my Chase account, and then from my Chase account, I'm gonna then pay it out to BMW. That's the way I'd have to do it if I'm in dire straits. Everybody with me? I want you to think about that metaphor when you think about excess cash for a company. All right? Excess cash for a company is like my Fidelity retirement account. And operating cash is like my Chase checking account. Okay? We pay bills out of our checking account. So, if a company were to increase the amount of excess cash it has, if I took a bunch of money and I put it into a retirement fund, I have less money available to pay my bills. That is why an increase in excess cash is negative to a CFI. Because the companies are doing the same thing. When they put money into excess cash, what they're doing is they're taking away from their ability to pay the bills from operations, and they have less CFI. The opposite is true. When they raid their savings account and they take their excess cash down, that is a positive to the CFI because they're basically adding to the cash that they have to be able to pay out. That's the sign on CFI. So basically, you can see here, if you look at your CFI, when they increase their excess cash, in this example, from 265 to 370, from a CFI standpoint, that took 105 million out of what could be paid to the debt and equity holders. That's why it's a negative. Okay? Hopefully clearing up for some of the people here. All right. So we made a little non-operating income. We made a bunch of non-equity investments. We added to our savings. We spent $345 million buying more equity investments in other companies that we don't control. We ended up with negative $440.6 million of non-operating cash flow. We take that plus our free cash flow, we generated $213.4 million. In this year, we had negative cash flow because we spent a lot more on gross investment than we made as profit because we did a big capital expenditures. We built a new plant. Well, we didn't make enough cash from non-operating activities, even though we made $248 million, because we sold some of these equity investments, but we were still $227 million short. The other side of the statement, so this side of the statement is all about how much cash we're generating. The other side of the statement is where did that cash go? And here's the idea. If I have negative 227, that means the money had to come from somewhere. If I generate 213.4, that means the money went somewhere. That's the way the statement is structured. So on this side of the statement, if the money went somewhere, positive numbers are payouts. On this side of the statement, if I needed the money, negatives are inflows. Okay? So I had a student in the first section asked a really good question. And he said, basically, Professor Perfetti, I don't get it. If I'm a debt holder and I gave you, in this example, $400 million, why is it negative? To me, I gave you $400 million to the debt holders. Yes, to you, the debt holder, it's to some degree an investment in the firm. But to me, the company, the reason why it's negative is I said, what do you think I'm doing with that debt? He said, what do you mean? I said, why did you give me $400 million? What I'm going to do as a company is I'm probably going to use that to build a plant. I'm probably going to use that to build working capital, build inventory. So from my perspective, on the other side of my statement, it's going to be an investment. Okay? So that's the point. It's going to reduce the cash of my business. Because if I build a plant for a few $100 million, that's cash going out my door. So what I'm going to do is I'm going to say your negative 400 funded my negative 400 of investment. The opposite is true. If I generated a bunch of cash profit and I gave it to you to reduce your debt, I'm giving you cash, right? It's not negative to me. I'm taking the cash that I generated profit and I'm recognizing $400 million of profit, $400 million of debt reduction. I was able to reduce your debt because I made the profit to reduce the debt. That's the way the other side of the statement works. Okay? So it's the other side, we kind of look through the looking glass. When we generate cash, those payouts to our investors are going to be positive numbers. When we use cash, and we need cash from our investors, those are going to be inflows, negative from the investors, because it's going to usually fund something on the top half of the statement that we need the money to do. Okay? So that's the point. From the income statement, these were the interest expense after tax. This was the change in debt from the balance sheet, pretty straightforward. This was the trick that I warned you about on Monday. When we get to the equity, the fours, these were the dividends. The minority interest is a dividend, for reasons we talked about earlier today. Preferred and common, those were the dividends. This is the change in equity. We didn't have a change in minority interest. We did increase our preferred stock, so that was an inflow. We didn't change our common stock. When you net all this up, 213.4, 213.4. And treasury stock is when we buy back our stock, we buy it back at market prices, not book value. So a change in the market price of the treasury stock is a stock repurchase. So we spent $245 million of cash buying it back in the first year and $75 million the second year. Those are outflows, those are positive numbers. That's how you've gotten your CFI to balance. Questions? Okay. Statement number 4, economic profit. Oh, by the way, before we go, preview. One of the things we're going to be doing next is we're going to be analyzing the CFI. Right? And I'll give you a hint of why we did these statements. Here's the thought. If we have a negative CFI, we have spent more money than we have generated. All right? We're $227 million short. I want you to look at the bottom half of the statement and tell me, where did we get the money to fund our losses? Where did we get the money to cover our $227 million hole? In column D. Look at on the right. Where'd the money primarily come from? Yeah.
Long-term debt.
Long-term debt. Because we increased our long-term debt by $400 million, and that was primarily to cover the $227 million CFI. On the income statement, in column D, how much did we pay in total dividends? Cash dividends. Column D. We had 50 common, we had 30 preferred, 22 minority interest. We had to pay $102 million of dividends. If we have negative $227 million in cash, how do we pay $100 million worth of dividends? I'm sorry? There was the debt. That's the 400. We took, of the 400 of debt, we had to pay 100 million dividends, which we didn't have. We borrowed money to pay those dividends. It's clear. In column C, the previous year, we had 213 million. Okay? So that's the point. We didn't need long-term debt. But here's the interesting thing. How do we pay out 100 million of dividends in column C and buy back 245 million worth of stock? How do I give my shareholders $345 million if I only have 213? That's why they borrowed 160 million of short-term debt. In both years, they couldn't afford the dividends and the stock buybacks. So this is part of the analysis you're going to be doing in your 500-word papers coming up very soon and your group project presentations. But you're going to start to notice that this is not sustainable. This is not banks are going to keep lending me money to give it to the shareholders, not forever. But that's what they're doing. They're borrowing money to make these shareholder payments because they don't have enough cash to do it based on the rest of their business. And we're going to start seeing these very clear views of what companies are really doing with these converted statements. Okay? And by the way, that leads to statement number 4, which is economic profit. Are we destroying or creating value in a certain year? Okay? 3 years, 2 years of data. Spread method. We have a 2021 spread based on beginning of year ROIC, current year NOPLAT divided by previous year invested capital of 4.9% and 4.8% respectively. Given an 8% WACC, we are not creating value. We have a negative 3% spread both years. Okay, so what does that translate to into dollars? Well, if I have 3.26 billion of capital that I am only making a negative 3% spread on, I have destroyed $99.8 million worth of value this year. I'm not meeting my capital target because I have a negative spread. It's translated to dollars. Or, another way of saying the same thing, I generated $161 million worth of profit at an 8% cost of capital. 8% of 3260 says I should have made almost 261 million of profit to give my investors 8% back. I only made 161 million. I am 99.8 million short of being able to pay them back at 8%. So I am profitable, but I am destroying value. That's economic profit. All right? And as I told other classes, you can actually operate for a while as a company, destroying value and making profit. Okay? Because there's 3 zones. When you think about spread, there's the positive spread. When you have a positive spread and you're beating your cost of capital consistently, investors leave you alone because they're just counting the money. You're creating value, and nobody's going to come in there and say, we're going to throw out management, you're doing a shitty job because you're making 30%. Like, that just doesn't happen, right? Situation number 2, you have such a negative spread that you basically can't pay your bills. You have giant negative free cash flows, and nobody's going to keep lending you money, and you go out of business, okay? But then there's this middle ground, what I'll call zone of pain, and it has to do with the WACC, okay? So you have an 8% WACC, but that's cost of debt, cost of equity. So let's say your cost of debt's 3%, and your cost of equity is 10%, okay? Just making up some numbers. And you make 4%. You can survive. Because as long as you can keep making those debt payments, you're not going into bankruptcy. Shareholders can get pissed off at you, but they can't force you into bankruptcy. They can try and throw you out. It's rare, happens, right? They can try and get on your board as a rater when your stock is down, but they can't force you out of business as long as you keep paying the debt payments. If you miss a debt payment, well, that's a different story. When you can't pay your debt anymore, you can't survive. So long term, if you can exceed your cost of debt, you can stay in business. You could be below your WACC and above your cost of debt and stay in business. That's the Walking Dead zombies. And those are the companies that can subsist, but they're not going to really make you a lot of money.
Is that like airline companies?
Well, it depends. Because what's going to happen is when you deal with those companies, you have to basically say, are they going to get out of this kind of like pain zone? Are they going to get above their WACC eventually? Well, think about this. If I suck because nobody likes my products and services, and my people aren't very good, and I don't have a lot of resources to invest in new product development and new marketing, how do I actually improve the business long term? Like when I'm in that situation, I'm going to be laying off people. How does laying off a bunch of people improve my customer service? How does laying off a bunch of people improve the products and services that I'm selling? So I'm saying when you get in the zone, it's kind of hard to get out of the zone because you need to spend money in the zone, but nobody's going to want to give it to you because you suck. All right? So I'm just saying it's rare, and that's what the book was telling you. When you see these companies below average, it's hard for a lot of them to flip it to that other quadrant long term because they don't really have a lot of money to invest. Hold on. But then there's an alternative. It's 2020, and you're an airline, and COVID's spreading around the world, and suddenly nobody's flying. So 70% of the passengers are gone overnight. Well, it doesn't matter how good you are, you're completely screwed. But passengers are going to return. That's where we are in 2023, 24, and airlines are going to start making money again. So that's a different story as an investor. I knew that that was just a market condition that was just transitory, so I'm not going to penalize all the airlines for basically going close to out of business because I know airlines are going to be there for the long term versus there's a company that's screwing it up. And why do I believe that that company screwing it up is actually going to turn it around? Now, some will, but some won't. And that's what I had to differentiate. But that's that zone of pain. Do I think that they're going to turn it around? Hopefully they will. I'll keep giving them, the bet. And even those companies that aren't going to turn around, people will still assume hope is a strategy for some people. Like, I hope they turn it around one day. I'll give them a chance. But the definition of insanity is doing the same thing over and over again and expecting a different result. And eventually investors get frustrated. And that's when you start to see the changes. And that's what you'll see today. You'll see companies, read Bloomberg, this company's going to lay off 10,000 people, right? Why are they laying off 10,000 people? Well, if Google's laying 10,000 people and they're making a 20% return, they're kind of trimming some hedges, right? You got another company's losing money, it's 10,000 people. Well, they're doing it because something's really fundamentally flawed with their business. They can't afford those people. Well, if they get rid of those people, is that going to actually make the business better? Like, what are they doing to make the business better? Like, you can't cut cost your way into growth. So something's going to eventually have to make some money. That's when we have to start distinguishing between investors. And by the way, when you put the CFI in this format, it will help you answer that question because you're going to get a much more clear line on what companies do. Make sense? This is where we're going next. All right. So for your next homework assignment, I've decided this one was not difficult enough. So what I'm going to do is I'm going to give you another company and I'm going to make you get the 10K, and using real world accounts without all of the 1, 2, 3, 4s, basically do the conversions. Just kidding. Thought I was serious for a second. So I had to screw with you a little bit. I know that this was the toughest assignment for you. I know some of you are very frustrated by the assignment, but we got to get to this point. Here's the good news. This is the only conversion you have to do. Okay? Going forward, when we get to the valuation, I'm going to take real world statements and give them to you in this format. They're going to be converted, and they will balance and they will work. Okay? But in order to do that, I make a choice. Because I either could have just given to you now, and you have no idea where these numbers came from, or I could have made you go through this little painful process to give a better appreciation of where these numbers come from. And it's more important to me you have an idea of where these numbers come from. So unless anybody says, no, I really want to do another company, I'm going to help you by not making you do this painful conversion process on the real world. But nonetheless, we're going to still talk about what they look like and analyze the results after that. That's where we're going next. Okay? So your next homework assignment is going to be analyzing companies. All right? And given that this class took longer than I thought, I'll give you a quick example. So back to lecture note 3. When we convert the statements, or lecture note 2, when we convert the statements, we're going to do 2 things. We're going to build ROIC trees, historical ROIC trees to understand what's going on with ROIC, operating ROIC, and we're going to build CFIs to understand what's going on with the cash flows of the companies, because that's going to give us a lot of understanding of the company. Got to understand their historical position. When we do ROIC analysis, which we're going to start next week, there's 2 levels of analysis we'll do that explain ROIC changes. Any company, 3 things drive changes in ROIC. Tax rate, margin, productivity. Okay? Any company, 2nd level analysis. 3 things drive operating margin from the income statement. Gross margin, SG&A, depreciation. 3 things drive productivity from the balance sheet, working capital, PP&E, and intangibles. Those are all the operating items you just converted. And by understanding those changes, you'll understand the changes in ROIC for a company. So, very quickly, Starbucks. Hopefully everybody's familiar with Starbucks. So I'm picking this as an example. This is 5 years of Starbucks historical ROIC. And the acronym on this page is EOY, which stands for end of year, which means current year NOPLAT divided by current year invested capital. On your homework assignment, I did current year NOPAT divided by last year's invested capital. That's BOY. Here I'm doing EOY, based on end of year. Okay? But here's the idea. In 2017, I'll try and make it a little bit bigger, Starbucks ROIC went from 48% to 23.2%. It fell by 51.9%. It went down. So the question is, why? Why is their ROIC worsening over the 5 years? There are 3 reasons ROIC changes. Reason number 1, tax rate. In 2017, Starbucks was paying a 33.2% tax rate. In 2021, they were paying a 21.6% tax rate. Is that better or worse for ROIC? Is 21.6% helping their tax rate versus the 33? Or is it hurting the ROIC based on that tax rate change? Does that help or hurt their ROIC? Should help. So paying less in taxes should help your ROIC. So the reason why the ROIC went down for Starbucks is not because taxes, because they're actually paying less in taxes. That should have helped them. That's driver number 1. If we take out the impact of taxes, we get the underlying pre-tax ROIC, which is their business of selling coffee. Their pre-tax operations went from 72%, which is pretty darn good, to 29.6%. So the underlying business that worsened. Why? Reasons number 2 and 3. Reason number 2 is what's called the operating margin. How much is left, EBIT, after they pay all their operating expenses? Higher being better. In 2017, they made 18.5 cents per dollar of operating profit. In 2021, they made 16.8 cents. Is that better or worse? Lower's worse. They're making less every time they sell a cup of coffee. That's going to hurt their ROIC. So that's a big clue as to why their ROIC is going down. Reason number 3, how much balance sheet invested capital are they spending to generate $1 of sales? In 2017, to generate $1 of revenue, they invested 25.5 cents. In 2021, to sell $1 of revenue, they invested 56.6 cents. Is that better or worse? That's far worse. They're spending more than twice the amount of money to sell the same coffee. Everybody see that? So drivers 2 and 3 both hurt their ROIC. Which one hurt them more? Approximately a 10% decline in their margin, or the doubling of investment on their balance sheet to drive $1 of sales? The doubling of the investment. It was the doubling of the investment. They both hurt, but the doubling of investment hurt more. That's the 250 words of the 500 words for your next assignment. Except we're not done. That's called the first level analysis. There's a second level of analysis. Second level analysis, what drives operating margin? 3 elements of the income statement drive operating margin. Gross margin minus SG&A minus depreciation equals EBIT. Those are the 3 numbers that drive that operating margin. What happened to the drivers of the income statement that caused the operating margin to go down? In 2017, here we go. They had a gross margin of 35.3 cents, 2021, 34.1 cents. That's the difference between the price and the cost of goods sold. So whether the price went down or the cost of coffee went up, they're making less in every cup of coffee they're selling as a gross margin. That's hurting their operating margin. Okay? And given I went down today to buy a cup of coffee, it was like $9 downstairs. I don't think it's the price. I think it's the cost is going up more than the price. SG&A, that's their spending and overhead. That's their marketing, admin, shared services, HR, training, whatever. 13.8 cents per dollar of SG&A in 2017, 13.4 cents per dollar in 2021. Slightly better, 0.04 cents, but not enough to offset the decline in the gross margin. And spending on depreciation went from 4.8 to 5.2. So spending a little bit more in their stores, spending a little less in SG&A, but it was really the drop in gross margin, which was dropping their operating margin. Finally, balance sheet. As you just did in your last homework assignment, invested capital is working capital, PP&E, and goodwill, intangibles. They had negative working capital, went from -5 to -7.5. Negative working capital means you don't have investment. More negative is better. Think about this. I used a credit card to buy the cup of coffee from Starbucks today. How long before Starbucks gets paid when you pay by credit card? How long before they get the cash? 2 days. Right? 1 to 3 days, usually 2. Right? So how long do you think it takes them to pay their coffee suppliers? The people that are selling them beans, you think they're paying them in 3 days? No, they're probably paying them 45 or 60 days. So if I'm getting paid by my customers in 2 days, and I'm paying my suppliers in 45 days, negative working capital. That reduces my investment. It's typical for a retailer. Now, if I'm a service firm that gets paid in 30 days, different story. Okay? Property, plant, equipment. This is what I'm spending on the stores, the equipment inside, and their land. I was spending 22 cents per dollar in 2017. I'm spending 50 cents per dollar on my stores to generate $1 of sales by 2021. That's where their productivity got hammered. And acquisitions. I spent 9 cents, 8.8 cents per dollar in intangibles, 13.9 in 2021. I bought somebody. By the way, the acquisition probably occurred between 2017 and 2018. Question for you, if you're doing this analysis, who'd they buy? You can look that up. But we know they bought somebody. So that's why their productivity worsened. It was the store productivity that got hammered. They spent way too much in their stores, didn't get enough sales to accomplish that, and they sold coffee to lower margin, and that's what we see happen to Starbucks during that 5-year period of time. This is where we're going next week. The good news for you, Bloomberg Trading Challenge, keep working on, okay? You don't have a homework assignment for Monday, okay? I'm gonna move that assignment to the following Monday, okay? As opposed to following Wednesday, make it easier for you. And on Monday, we're gonna go through these trees and these CFIs, lots of practice. But then you're gonna be doing the analysis next week, okay? Have a good week. Where's the sign-in sheet? Make sure you sign the sign-in sheet. If you didn't sign it, oh, actually, take it back. Here's the sign-in sheet. Please sign the sign-in sheet before you leave.